So in this video, we're actually going to discuss what's the limitation for the monetary policy, similar as a fiscal policy. So we're going to discuss what is limited the effectiveness of the monetary policy. So in the previous video, we learned that, okay, it's kind of very interesting if we changing the money supply actually going to eventually affect the aggregate demand. But the question is, by how much? So can we really achieve to close the recessionary or the inflationary GDP gap? So that would be the question. So actually the answer is the reality is not as beautiful as the theory. So the reason is because the following. So when we talk about monetary policy, it will we have to distinguish what is the short-term and the long-term rates. Short-term and long-term rates. So the Fed has a greater influence on short-term rate, so that is the federal funds rate. So the federal funds rate we talk about, so how they affect the rate that the money can borrow from them. So, but they actually have less effective to affect the long-term rate, which is a broader rate and affecting every public, every individual in the nation. So the long-term rate, including mortgages and installment rate. So monetary stimulus will be most effective if long-term interest rate change mirror short-term rate change. And if not, the aggregate demand increase will be less than hoped for. So that's what I want to let you know is, unfortunately, the federal government is less likely to affect our long-term rate. So, for instance, what happened in the history? So in 2000, the Fed reduced the federal fund rate by 4 percentage percent between January and September. So the biggest reduction in short-term rate since 1994. However, the long-term rate fell much less, and the interest rate on 30-year mortgage, for example, fell less than half a percent point in the first few months of the monetary stimulus. So the similar scenario happened in 2004 and between 2004 and 2006. So generally speaking, and the government will feel a little frustration when they talk about monetary policy because it'll be more effective to affect the short term than the long term. So which means it may not affect the aggregate demand curve at all. And so this is the one problem. And then the second problem is called the reluctant lender. So the reluctant lender. So what does that mean? Banks must be willing to increase lending activity, right? So when reducing the reducing interest rate, so that means you're assuming the bank will be willing to lend out the monies. Bank actually may pile up excess reserve instead of making loans. So that's the reality. So what's the reason behind it? Because the banks worry about their financial well-being. So because they feel, okay, the economy is not working well, so they don't want to lend out too much money. So they prefer to reserve more so that just in case money when people come to withdraw the money, they will have the money. And also they worry about not being paid back by weak borrowers. So it happened in 1929 to 1933, the Great Depression. So bank doesn't want to borrow money because they know people will not be able to, or the business will not be able to pay back. And also they worry about how new bank regulation may affect their profitability. So these all their worries. So all those problems will result in the monetary policy ineffective. So the bank is not corporate. So the bank is not corporate. So what's another problem? So that's called liquidity trap. So lowering interest rates too far eliminates the opportunity cost of the holding M1. And the public simply hold the money instead of investing. So what we call this is as the liquidity trap. So people are willing to hold unlimited amount of money and some lower interest rates. So do you remember when we are lowering the interest rate? So if we are lower the interest rate too low, and instead of stimulate more investment, actually people will want to holding more money. So holding more money in people's hand, that means we have less chance to stimulate more investment and to start our positive multiplier effect. So this is the third problem associated with the monetary policies. So how about the next problem? It's called a lower expectation. So how that works? So in a recession, firms have little incentive to expand the production capacity. So there will be little expectation of future profit or return on investment from new investment. And so even the government try to issue more money, lower interest rate, but the investor, they just say, no, I don't expect the economy going to recover. So no matter the interest is low enough, we just don't want to borrow because we don't think an investment will be paid back. So for the consumer side, and the consumer may be reluctant to take on added debt when future income perspective are uncertain. So during the Great Recession, it really happened, and so the people are worried about their future. They have no confidence about future, and they are not believe economy going to recover. So that's what happened. Is lower interest rate may not shifting our aggregate demand curve to the right. And the last problem is called a time lags. So what does time lags? So think about when the government say let's lower interest rate. Do you think it's going to happen next day? No, that's not the case. You have to understand any policy take time to be effective or take time to affect the world. So it's called a time lags. So it takes time to develop and implement a new investment in response to lower interest rate. And the consumer also may take time to decide to increase their borrowing. So generally speaking, it may take 6 to 12 months before market behavior responds to monetary policy. So all those factors will contribute the ineffectiveness of the monetary policies. Sometimes it's a minor effect, and sometimes will be the major effect. So please be aware of those constraints. So that's why, compared with the fiscal policy and monetary policy had more a disadvantage than advantages. So that's why what we usually see is um, um, more fiscal policy than the monetary policies. So you can see it take a while for the Federal Reserve Bank to decide to raise interest rate or lower interest rate because so many disadvantages are associated with the monetary policies. So in next video, what we're going to discuss is from monetary perspective, how they think about monetary policies. Do they think the monetary policy is effective?